The Federal Reserve is quietly sitting on $2 trillion of your mortgage debt. $2 trillion of American home loans sitting inside one building, and most homeowners making their payment this month have no idea. Right now, Americans collectively owe $13.2 trillion in mortgage debt. That number comes directly from the Federal Reserve Bank of New York. The average American homeowner carries $269,560 in mortgage debt today. That is not a small number for a working family in this economy. And here's what changes everything about that number right now. A brand new Federal Reserve Chair just took his seat this week. His name is Kevin Warsh, and he was confirmed just days ago. He inherited $2 trillion of mortgage-backed securities on day one. Before you scroll past, subscribe to Dollar Grid for more like this. This channel breaks down what the financial system is actually doing, not what the headlines say, what the data and documents show. Hit subscribe now because this story is only getting started today. Now let's go back to where this whole thing actually began. The year was 2008. And the American financial system was collapsing. Banks were failing. Mortgage securities were worthless. Credit markets froze. The Federal Reserve stepped in and did something it had never done. It started buying mortgage-backed securities directly from the financial market. Trillions of dollars worth of home loan packages entered the Fed's books. That single decision changed the relationship between Americans and their mortgages forever. Most homeowners never noticed, but the ownership of their debt shifted. Your mortgage didn't disappear. It just ended up in a very different place. By 2010, the Fed had purchased roughly $1,025 trillion in mortgage securities. That was just the beginning. The pandemic made everything dramatically bigger. In 2020, the Fed launched another massive round of emergency asset purchases. Mortgage rates dropped to historic lows and the housing market exploded upward. The Fed's mortgage-backed securities portfolio ballooned to nearly $2.7 trillion total. For context, that is larger than the entire economy of France's housing sector. Now here is where it gets personal for every American homeowner today. Those mortgage securities the Fed holds are not abstract Wall Street instruments. They are pools of actual home loans from real people across America. Your loan may literally be one of the assets the Fed holds. Fannie Mae, Freddie Mac, and Ginnie Mae guarantee those mortgage-backed securities. That means the loans inside them are standard American residential home mortgages. When the Fed bought those securities, it became the backstop for millions of loans. And now Kevin Warsh has walked into the building that controls all of it. Warsh is 56 years old, a Stanford and Harvard-trained former Fed governor. He became the youngest Fed governor in history when he was appointed at 35. Trump nominated him in January 2026, and the Senate confirmed him 54-45. That confirmation vote was the most partisan in Federal Reserve history. Democrats were worried, Republicans were celebrating, and markets moved immediately. The Dow dropped 245 points the day his nomination was announced in January. That reaction tells you the markets understood something important about what comes next. Warsh has been openly critical of how the Fed expanded its balance sheet. He called it a distortion of financial markets and a policy that must reverse. At his Senate confirmation hearing, he called for a regime change in monetary policy. Those are strong words from someone about to control $2 trillion of mortgages. He told senators the Fed has an interest rate tool and a balance sheet tool, and he made clear he intends to use both tools very differently than before. Before Warsh arrived, the Fed under Jerome Powell had already been shrinking things. Since June 2022, the Fed reduced its total securities holdings by about $2.2 trillion. But the mortgage-backed securities portfolio has been the slowest piece to shrink. Why? Because selling them is extraordinarily complicated and financially dangerous. One source described the Fed's MBS position as so big, it literally cannot be sold quickly. The Fed currently owns almost 25% of the entire agency MBS market. If it tried to sell quickly, it would crash mortgage-backed securities prices completely. That would send mortgage rates significantly higher for every American homeowner overnight. When the Fed holds this debt, it exerts a quiet downward pressure on rates. When that holding starts to unwind, the pressure on rates goes the other direction. And that is exactly what Warsh has signaled he wants to start doing. His stated goal is to reduce the Fed's footprint in housing finance markets. Think about what that phrase, reduce the footprint, actually means for homeowners. Right now, that footprint is the reason mortgage rates are not dramatically higher. The 30-year fixed mortgage rate in early 2026 is sitting at about 6.25%. That rate exists in a world where the Fed still holds $2 trillion in MBS. The moment Warsh begins actively shrinking that portfolio, the rate equation changes. Research from Wisdom Tree and Columbia University's Business School confirms this directly. Professor Yiming Ma from Columbia explained it plainly. Reducing the balance sheet is tightening. Less Fed demand for mortgage securities means higher yields for the market to absorb. Higher yields in the mortgage securities market translate directly to higher mortgage rates. And higher mortgage rates mean higher monthly payments for every new American homebuyer. For existing homeowners looking to refinance, higher rates mean the window starts closing. The Congressional Budget Office currently estimates a federal deficit of 5.8% of GDP. That is far above the 50-year average deficit of 3.8% of GDP. That fiscal reality will make Warsh's plan harder to execute than it sounds. Stephen Marin, a fellow Fed official, estimated the balance sheet could shrink by $1 to $2 trillion. But he also cautioned the market that speed matters enormously in this process. Moving too fast risks disrupting funding markets and creating ripple effects across housing. Moving too slow means the Fed's footprint in your mortgage doesn't change at all. And that tension between speed and stability is exactly where Warsh begins his tenure. The stakes sitting on his desk right now are not abstract policy numbers. They are the mortgage balances of 86.94 million American households across this country. The stakes sitting on Warsh's desk are 86.94 million American households. That is not a statistic. That is your neighbor, your parent, your family. Every single one of those households carries a mortgage tied to Fed policy. And the man now controlling that policy just changed for the first time in 8 years. Kevin Warsh wrote a Wall Street Journal opinion piece that explained his position clearly. He called the Fed's balance sheet bloated and designed for a bygone crisis era. Those are not casual words from someone who just controls interest rate policy. Those are the words of someone with a specific plan for that $2 trillion portfolio. Warsh argued that reducing the balance sheet would free up room to cut short-term rates. On paper, that sounds like good news for American homeowners who want lower payments. But here's the part that most financial coverage is completely failing to explain. The 30-year fixed mortgage rate does not follow the short-term federal funds rate. It follows the bond market, specifically the yield on 10-year Treasury securities. And when the Fed starts selling mortgage-backed securities, bond market dynamics shift fast. Here is the exact mechanism that matters for every homeowner watching this video today. When the Fed holds mortgage-backed securities, it creates consistent demand in that market. That demand keeps mortgage-backed securities prices elevated and their yields suppressed. Suppressed yields in the MBS market translate directly into lower 30-year mortgage rates. The moment the Fed withdraws that demand by selling its $2 trillion portfolio, prices drop. When MBS prices drop, yields rise. When yields rise, your mortgage rate rises too. Columbia University Business School professor Yiming Ma explained this directly to Fortune magazine. She said reducing the balance sheet is tightening, just like hiking the federal funds rate. The difference is that most Americans understand rate hikes. Almost nobody understands this mechanism, and that gap in understanding is exactly what is happening to millions of homeowners right now. As of April 2026, the Fed held $1.993 trillion in mortgage-backed securities still on the books. The reduction process started in June 2022, and it is already 24 months behind schedule. By design, roughly $1.593 trillion should have been trimmed, but only $714 billion has been removed. That means the process is less than half complete, and Warsh just inherited the unfinished job. His first FOMC meeting as chair is scheduled for June 16th and 17th of 2026. That meeting is where financial markets are watching for the first signals of his direction. Analysts at WisdomTree noted investors are listening for whether Warsh wants passive runoff or active sales. Passive runoff means the Fed simply waits for mortgages to mature and be paid off naturally. Active sales mean the Fed enters the market and sells the MBS portfolio directly and immediately. Active sales would be the faster path, but also the most disruptive path for American homeowners. If active sales begin, mortgage rates could move meaningfully higher within weeks of the announcement. Current 30-year fixed rates already sit at around 6.25 to 6.5% in May 2026. Analysts at Reuters reported investors are already pricing a steeper yield curve under the Warsh Fed. That steeper curve means more rate risk for the market and ultimately more cost for borrowers. And it comes at a moment when affordability is already at historically difficult levels for buyers. Monthly mortgage payments in 2026 are roughly 50% higher than they were just 5 years ago. The median home price in February 2026 hit $398,000 according to the National Association of Realtors. A first-time buyer today faces a $398,000 home plus a 6.25% mortgage rate simultaneously. That combination is unlike anything the housing market has faced in the modern era of homeownership. Adding upward pressure on rates through MBS sales into that environment is not a small policy detail. It is a decision that directly determines whether millions of Americans can afford to buy a home, or whether the 86.94 million existing mortgage holders can afford to refinance when rates finally move. Now here is something the financial media is not connecting clearly enough for ordinary Americans. Warsh has simultaneously argued for cutting short-term rates and reducing the mortgage balance sheet. He believes those two moves can work together if they are sequenced and communicated carefully. The argument is that cutting the federal funds rate reduces the cost of short-term borrowing. while selling MBS returns the long-term mortgage market to private demand and natural price discovery. In theory, that is a principled and coherent monetary policy framework rooted in economic discipline. In practice, it means the short end of the curve gets cheaper while the long end gets more expensive. For homeowners, the long end is the one that matters. The 30-year rate lives on the long end. So the scenario where Warsh cuts rates but mortgage rates stay elevated or even rise is very real. The truth about mortgage reported plainly that Warsh is not coming to save mortgage rates for Americans. And this is the part where the average homeowner needs to stop waiting and start positioning themselves. If you have a mortgage right now and rates are in the window you need, that window may be closing. The Fed's first mover advantage in suppressing mortgage rates is being deliberately unwound this year. Inflation jumped from 2.4% in February 2026 to 3.8% in April, according to BLS data. The Iran conflict has pushed oil toward $100 per barrel, and that is feeding inflation directly upward. Fed officials with voting power have already signaled serious inflation concerns inside the FOMC committee. Warsh cannot simply cut rates into a 3.8% inflation environment without risking serious consequences. That means the patience of American homeowners waiting for dramatically lower rates may be tested further. The realistic outcome from most economists is perhaps 2 modest rate cuts somewhere in late 2026. Christopher Hodge, chief U.S. economist at Natixis CIB Americas, said he thinks the Fed cuts twice this year, but he also said no significant policy change happens immediately after Warsh officially takes over. That means the homeowners who understand this transition have a window to make informed decisions now, not panicked decisions, not reactive decisions, informed decisions based on what the data actually shows. The $13.2 trillion in outstanding American mortgage debt does not care what headlines say this week. The $2 trillion portfolio on the Fed's books is real, and Warsh's plans for it are real. The mortgage payments of 86.94 million Americans will be directly affected by what happens next. This is not a story about Wall Street. This is a story about your kitchen table finances. It is about whether you lock in, refinance, wait, or reposition before the market recalibrates completely. The new Fed chair is sworn in. The balance sheet conversation is no longer hypothetical anymore. What happens to your mortgage in the next 12 months will be decided in policy meetings, not headlines. The homeowners who understand that difference are the ones who will navigate this transition successfully. If this video gave you something that the mainstream financial media did not, subscribe to Dollar Grid. Drop a comment below and tell us what you want Dollar Grid to break down for you next. Every week, this channel brings the real financial story behind the numbers that affect your life. Subscribe now, comment below. Dollar Grid is where your financial education actually starts today.